As a reminder, this is not a source to receive financial advice. We are more focused on forward-looking impact assessment methodologies. All right, so today we are joined by two exciting speakers who will be talking to us first about the SEC climate disclosure regulations that just came out. You know that this is a little bit outside of our impact methodology focus, but know that is critical to our community. And so we're really excited to welcome Jake Raskoff for his presentation. And we will also be going through a case study with Prime's own Jenny Zhang. And I will also be covering the annual report that we just completed this past year. First and foremost, before we kick off, I wanted to make sure to thank everyone at the top. I was out for a while on parental leave, and I have just been overwhelmed by how supportive and diligent everyone has been in the Project Frame community, whether it's Prime staff, who you will see here today, or others who support Project Frame's work. So thank you very much for keeping the really important work going and for joining us here today. A little bit about Project Frame. If you're new to our group, we are a nonprofit program convened by Prime Coalition, and we hope to organize investors around forward-looking emissions impact methodology and reporting best practices. It is our hope that we demystify emissions reduction potential analysis so it becomes more commonplace in all walks of life for venture investors looking to invest for a safer, more secure climate. Our aim is to improve impact measurement management standards and climate-driven investments, and we do this by galvanizing a network of leadership around transparency and collaboration. As a reminder, this is where Frame sort of fits in what we call our pathway of change for climate change mitigation. Ultimately, we are developing this community of practice and hoping that we can scale both our ups and others in methodology and create more common terminology in a very muddled space to operate in. We hope this means that all of our practices will be optimized for GHG impact, and that will go towards the best possible solutions to mitigate climate change. A little reminder and shout out to our steering committee members that are listed here. If you're really good, you'll notice that there are two new steering committee members, which I will introduce and thank a little bit later in my presentation. Twice a year, we update our membership numbers to see where we're at. As of December, we are excited to have an additional 131 observing members, which make up 83 investment firms and $471 billion in venture capital and private equity amongst the investors. This means that we have a lot of capital to do a lot of good in the world, and we continue to see the rise in interest only invigorates our want to really create solid methodologies and best practices. So thank you. All right, first on the updates, I want to welcome or applaud Green Artha and World Fund for joining Project Frame's steering committee. Both of these groups are real leaders in their field, both as investors and as thought leaders broadly. We're super excited to be working with them, and they have had members of their team integrated into Project Frame since the very beginning. There'll be more to come on that in the newsletter, but we just wanted to give them a short shout out here. And we also want to make everyone aware that the Crane tool, which was also originally built by Prime Coalition in partnership with Row Impact, will be launching a new version of Crane at San Francisco Climate Week. The reason I'm bringing it up here is because we are making sure that it is aligned with Frame's pre-investment methodology. It is a free open access tool that helps operationalize ERPs to make it simple and more accessible for those who would like to try it. And we're really appreciative of all the feedback we got and hope that it can serve as a tool not only just to help investors, but other tool developers that are working in this space. We are in the process of updating our methodology landscape assessment that we did originally in 2022. We've been collecting relevant organizations that are relevant to our work across scopes. And so we can better understand where Project Frame fits and understand the landscape for all of our investors. We are also in the process of updating our investor profile platform and have a simplified version for those who aren't quite ready to commit to a full investor profile. We have something called snapshots. If you are interested, we'll have a slide with our email later where you can submit your interest. And first, we also wanted to make sure that everyone has the opportunity to possibly participate in a case study example as well. And I will give another thank you to Jenny because she'll be one of the first here to present a case study. All right. On the methodology 101, we do plan on both broadening and deepening the methodology over the next several months. We've had an amazing content working group over the past couple of years with over 20 investors who have been reflecting on the methodology to date. One will be a 101 course. Many of you who follow Project Frame got access to a little bit of the beta at our last community meeting. If you are interested in being involved and being recognized for your support of Project Frame, we highly encourage you to review that recording, and we will have a link where you can provide feedback. So far, the feedback has been overwhelmingly positive, but there's always room to improve. So we hope to officially launch the beta this summer, as well as some important updates to the methodology itself. So it's going to be a very busy and exciting time for Frame. In an effort to make our content more accessible, we are in the process of providing translations to the original methodology. So far, we have translated or in the process of completing translations in both Japanese and Mandarin. If this is something that you're interested in, we are open to doing other translations. So please contact us at impact@primecoalition.org if there is a language that you think would be vitally important to the uptake of the methodology and increasing learning and accessibility, especially in emerging markets where we feel that we can do a lot of good work. All right, now that I am done with my part, I would like to go ahead and introduce both of our speakers today. First, we will be joined by Jake Raskoff. He represents Ceres and is within their accelerator for sustainable capital markets, but he in particular leads their climate financial regulation work. He has experience working for the U.S. Senate for Senator Schatz, where he was the lead for the special committee on the climate crisis and has also previously done work with Goldman Sachs. Thank you very much, Jake, for joining us. Next, we'll be welcoming Prime's own Jenny Zhang, who is an impact manager on Prime's impact team, and she does due diligence on Prime's own investments that we have through our steering capital strategy. She previously did impact analysis for financial organizations like TPG Rise Climate Funds and the World Bank. Thank you so much for joining us. Jake, I'm going to allow you to kick it off first.
Thank you, Carrie. So as Carrie mentioned, I represent the Ceres Accelerator for Sustainable Capital Markets, which is our regulatory team at Ceres. But we also have an investor network with over 200 institutional investors, both asset managers and asset owners, collectively managing about 45 trillion in assets. So we really do represent the investor voice when we advocate before regulators like the SEC. So quickly, I will just leave this up on the screen for 15 seconds and let people read it at their own pace here. Great. So just some high-level framing. I'm not sure how familiar the people on the call are with the SEC's mission, but basically the SEC is the U.S. securities regulator. So they govern the disclosures of public companies in the U.S. So there's about 7,800 what we call SEC registrants. Most of those are publicly listed companies with a New York Stock Exchange or NASDAQ listing. So this rule applies to U.S. public companies, both domestic companies as well as foreign private issuers who file Form 20F. So we're really only talking about the universe of public companies here when we talk about the SEC's rule. So the SEC adopted their rule on March 6th, very recently, in a 3-2 vote. This rule was proposed 2 years ago, almost to the day in March 2022, but the history goes back a long way. The first time Ceres brought investors in before the SEC to advocate for better disclosure on climate risks was actually in 2003. So for more than 20 years, investors have been asking for better data on climate risks. That led to, in 2010, the SEC put out interpretive guidance, and that's basically governed this disclosure landscape ever since. But the 2010 guidance didn't work. So it didn't have the force of law that a rule does. And also, it didn't lead to the sort of consistent and comparable and investor grade disclosures that the market needs in order to assess these risks. So the SEC did an analysis of basically public companies' 10K annual reports between 2016 and 2022 and searched for certain keywords related to climate. And only about 35% of SEC registrants were disclosing anything related to climate change. And then within that, there was absolutely no guarantee of consistency or comparability or using the same metrics. So basically, this status quo was costly for investors. On average, institutional investors were going out and spending about $1.4 million annually just to assess this like alphabet soup landscape of different voluntary disclosure standards. Within those, obviously, different companies use different standards. There's very little uniformity. So it was costly on the investors. And a lot of people talk about the cost burden on companies to disclose this information, but ignore the fact that investors who actually need these disclosures had to spend considerable resources getting them. As I mentioned, it was really inconsistent disclosure. And when an investor is making portfolio-wide capital allocation decisions, as everyone on this call knows, they need to be able to compare apples to apples. Basically, company A's risk exposure and risk management versus company B, if that company's a peer in their sector. That gets to the third point here. The disclosures were not investor grade. When this stuff is in the voluntary corporate social responsibility report, for instance, it's not subject to the same level of sort of rigor and scrutiny that information in an SEC filing is. And so that really leads to unreliable disclosures and the risk of greenwashing. Basically, companies can just say what they want, but there's really no guarantee they're working with legal counsel and auditors on these disclosures, and it doesn't rise to the same level as the financial disclosures in a 10K would. So what is the rule not? And this is where we get into the political messaging around this. I should just underscore the SEC has zero climate policy mission whatsoever. They are not a climate regulator. They're not the US EPA. Their only mission is providing transparency to investors. This is the bargain that Congress set up in the 1930s when they set up the SEC. The SEC just stands between the companies that issue the capital and the investors who buy it. And the SEC ensures that there is transparency and meaningful disclosures that allow investors to assess a company's prospects and risks. So the SEC does not actually care if or how a company is managing their climate risk. They do not care if a company sets a transition plan or wants to mitigate their emissions. All that they are saying is the company needs to tell their investors whether they're doing it, and if they are doing those steps, how they are doing it. So the rule is absolutely not climate policy. This is bread and butter financial disclosure policy that benefits investors. And when you hear opponents of the rule say, well, in the Securities Act of 1933, there's no mention of climate change, that's not really a gotcha. Like, these risks evolve over time. The SEC recently adopted a rule on cybersecurity disclosures. Like, the SEC is well within its authority to mandate the disclosure of financially relevant information that's in the public interest. And that's all this is. Point two, we don't even use the words ESG or sustainability when we talk about this rule. So unlike other disclosure regimes, most notably the EU's Corporate Sustainability Reporting Directive, or CSRD, the SEC's rule deals exclusively with material climate-related risks to companies' financial and operational well-being. So those could be physical risks or transition risks, but there's nothing in here about resource use or biodiversity or human capital management or human rights. The EU regulation touches all of those. The SEC's rule does not. And then third is that, just as I said, the SEC doesn't particularly care how companies are managing these risks or if they're doing so. There's nothing in this rule that requires an investor to, for instance, divest from a polluting or carbon intensive company. Again, this is about transparency. I don't think there's many investors out there who are, allocating capital to oil and gas companies, for instance, who are only doing so because there's not a disclosure in the 10K letting them know that those companies emit greenhouse gases. Like, everyone knows that. This is about, if you're going to invest in this sector, look at company A and company B and how well positioned they are to manage their physical and transition risks and how seriously they're taking the risks. So the SEC makes absolutely no value judgment about whether investors should be putting their money in any certain company or sector. It's just give the investors the transparency, the information, let them do with that what they will. So as I mentioned, the status quo was very inconsistent and fragmented and basically wasn't working. So this is a heavy-handed slide, but just to show you some of the components in this rule that didn't exist beforehand. There's a really unique requirement in the SEC rule that I'll get into a little bit further on about the actual integration of climate metrics into the audited financial statements in the form of a footnote. That did not exist before within SEC disclosures, nor does it exist anywhere else in the world. The SEC is actually the first regulator that we're aware of to mandate that. Companies will have to disclose their governance of these risks, both at the board level and the sort of committees that the boards have set up to manage these risks, and at the actual day-to-day management level. Strategy, business model, and outlook. This includes the risks to which you're exposed, your plans to mitigate those risks, and any tools you use to mitigate those risks. So that can include transition planning, scenario analysis, the use of an internal carbon price, things like that. Targets and goals disclosure. This is basically one of the stronger anti-greenwashing measures in the rule. If your company has set a target or goal to manage a material climate risk, you have to year over year disclose your progress towards that goal using quantitative and qualitative metrics to let investors know your progress. And then lastly, greenhouse gas emissions. And this attracted certainly the most attention of any provision in the rule. It was the most controversial. And as I'll discuss in a moment, the SEC did end up dropping out Scope 3 emissions requirements. So here are the key changes between the proposed and final rule. I've discussed how important the change was from the status quo to now, but between what was proposed 2 years ago in 2022 and what was finalized last month, a lot changed. The first is that the SEC added a lot of materiality qualifiers throughout the rule. And materiality is the cornerstone of US securities law, but it's also a notoriously fuzzy concept. It's basically what would a reasonable investor need to make their investment and voting decisions. And so this is defined in Supreme Court case law, not in statute. So both the reasonable investor and materiality itself are concepts that have evolved over time in case law. But a lot of people characterize this as, well, for instance, scopes 1 and 2 emissions, which are now subject to a materiality qualifier. There was reporting that now this is voluntary or optional for companies to disclose. That's not what material means. This is not a trivial determination for a company to make. They have to reach that conclusion in partnership with certain gatekeepers, notably their legal counsel and their auditors. They have to actually make a reasoned case why information is immaterial if they choose to withhold it. So it certainly leaves more discretion to management than we would like on things like emissions disclosure, but that doesn't mean it's voluntary. Number two, as I mentioned, scopes 1 and 2, which originally as proposed were mandatory for all companies in all circumstances, those are now subject to a materiality qualifier, and also smaller reporting companies and emerging growth companies, which are two categories of filer status that the SEC uses. Basically, smaller companies and those who newly went public, they don't actually have to disclose emissions at all. And then the final rule did drop scope 3 disclosure, which was originally proposed if material or if the company has set a target or goal that includes scope 3, they would have had to disclose that. I think it's worth underscoring that the SEC is the exception, not the rule on scope 3. Basically, every other mandatory climate disclosure regulation around the world, whether it's the CSRD, the laws that California has adopted, the ISSB, which is the global standard that many countries are expected to adopt, they all require scope 3. So the SEC is operating in a unique legal and political landscape. They received over 24,000 public comments on the rule, which is the most in the agency's history. And a lot of those were about scope 3, not only the sort of costs and unreliability of the data that some people were arguing, but also on whether this bumps up against the limits of the SEC's statutory authority. Because I think, as everyone knows, scope 3 is outside of your direct operational control, and you have to get that information from counterparties or suppliers in your value chain. So that's really the only place where private companies, non-SEC registrants, could have been implicated, because a reporting company may have requested data from their suppliers on those emissions. It was not required of companies to do so. They could have always relied on estimates and averages, and it was frustrating seeing the discourse about this is going to bankrupt family farms and drive small businesses out of business. And it was always unrealistic that like McDonald's or Pepsi would go to thousands of farms and demand hourly emissions data, but it became something of a political football. I won't dwell on the financial statement footnote too much because it's fairly technical, but just know that I mentioned it's a first of its kind requirement to actually include a footnote in the audited financial statements about these climate metrics, but the SEC did scale that back as well. They removed most of the transition related expenditures from the financial statements themselves and put those in the narrative portion of the filing. So it's a little bit like lower level of rigor associated with that. And then the timing of disclosures. Basically, all these disclosures are staggered both by the company's filer status. So the larger companies that have been public for longer will be the first to disclose. And then also within that, there's various categories of these disclosures that are also adopted on a phased in basis. So emissions disclosures do not start in year one for any reporting company. You have additional time to set up your controls and procedures for that, and various other categories of disclosures within the rule are also phased in. So I guess high level takeaway is the SEC made a lot of accommodations in the final rule to recognize the public comments they received. They were extremely responsive to all the criticism they got. So much so that now you have environmental groups suing the SEC as well on the basis of scope 3 being dropped out and other modifications in the final rule. So they succeeded in pleasing very few people, but as a representative of investors, Ceres feels that this is still a huge improvement over the status quo. It will serve investors well. It's hopefully a baseline from which we work. So at a later point, maybe we revisit the question of emissions disclosure, for instance, but let's defend this rule in court and get it implemented before we turn to questions like that. Um, I have other slides that go into more detail on all these various points, but I'd rather actually just wrap up on kind of a status check on where the rule stands. So there have been, I think, something like 10 lawsuits filed against the SEC. Those were filed both by trade associations like the US Chamber of Commerce, individual fossil fuel companies, and as I mentioned, some environmental groups. So I think it was 6 different circuit courts of appeals that the parties filed in. Those have now been consolidated in the Eighth Circuit Court of Appeals in St. Louis, which is a heavily Republican court, but less so than the Fifth Circuit, where a lot of these parties sued. So the SEC actually voluntarily stayed this rule themselves last week. And you may have seen reporting on that. And I just want to make sure it's characterized correctly. So the Fifth Circuit Court of Appeals actually initially stayed the rule a few weeks ago. When the venue lottery took place and this moved to the Eighth Circuit, that stay was lifted. But then the US Chamber of Commerce filed for another stay in the Eighth Circuit. And the SEC took the surprising and somewhat uncommon move of voluntarily staying the rule themselves, but that was a tactical and procedural choice on their part. Basically, they're trying to avoid spending weeks arguing about the costs of the rule and the burden on reporting companies with the chamber, where they might have had an unfavorable outcome. And they're trying to just reach some sort of expedited briefing schedule where they can get to arguing the merits of the lawsuits faster and not waste time on the costs. So that was their choice in doing so. They still intend to vigorously defend this rule in court. They've been very clear. They think that the voluntary stay actually helps their case rather than hurts it. So if you see reporting that like the SEC, had second thoughts about their rule and actually hit pause, that's not what that is. That's a purely tactical choice. And then there have been Congressional Review Act resolutions filed in Congress as well. What that is basically, if each chamber votes by a simple majority to overturn this rule, then the SEC would not only have to scrap this rule, but they couldn't even revisit the question of a similar rule in the future. So it's a pretty blunt instrument. Obviously, we would hope that President Biden would veto that if both chambers succeeded in passing it. But at the moment, we're doing a lot of work in Congress to try and prevent a successful vote in the first place. But there are various categories of opponents of this rule. The scope 3 stuff attracted a lot of controversy, and there were both Republicans and Democrats in Congress who brought up the agricultural interests in their state first and foremost and wanted to strip out scope 3. So they were successful. And you saw the American Farm Bureau Federation, for instance, taking a victory lap and issuing a supportive press release about the final rule. And then there were company and practitioner level practical concerns about elements of the rule that they found unworkable. And that sort of gets at point number 3 on this slide about the financial statement footnotes and modifications the SEC made there. And then there are people for whom the fact that the SEC even said the word climate is unacceptable. And that's more of a political and philosophical position than it is a practical one. And so those people are going to oppose whatever the SEC finalized, but that's who we're currently up against.
Thank you so much, Jake. That was fascinating. All right. So Jillian has her hand raised.
Jake, that was fascinating. Thank you so much for that overview. In the context of this coming SEC verdict, do you have any advice or thoughts for early stage investors if you're thinking about an IPO as an exit strategy and kind of how to think about that throughout the investment process?
Yeah, it's a great question. So one of the arguments that opponents of the rule make is that this will actually deter companies from going public because of the burdens associated with the rule. Speaking for myself, I would say that if climate disclosures are the thing standing between you and being a publicly traded company, like you may want to rethink whether it's time to be a public company, because particularly the final rule and all the modifications the SEC made, the cost burdens associated with this, they vary widely, and a lot of it is dependent on whether the company has already started disclosing this sort of information on a voluntary basis, or because they're subject to the California laws that apply to both public and private companies, or the CSRD in Europe, which similarly uses a revenue threshold and not a public equity check. So a lot of companies have gotten a head start on voluntarily reporting these risks, and many of the companies that we speak to do not see the SEC rule as necessarily a significant barrier that they have to hurdle over. Like they see certainly the EU regulation as a lot more difficult to comply with. So I would say that if you're considering an IPO in the next few years, certainly start having conversations with your portfolio companies about climate reporting. Consider whether the use of a voluntary standard like the SEC rule is underpinned by the TCFD framework and the greenhouse gas protocol in the case of the emissions disclosure. Those are both the framework that the CDP questionnaire uses, for instance. The ISSB is this new standard that's actually absorbed the TCFD, and that's going to be the global baseline. So thinking about getting your heads around the ISSB standards. But I would just say, just as you might consider setting up the controls and procedures necessary for public company reporting on your audited financial, the intent of this rule is to elevate climate disclosures same level as those. So if you're reporting emissions, consider whether you're getting third-party verification and an assurance on those emissions disclosures. Like I would say, just start considering your climate risk disclosure on par with anything else that counsel and auditors would advise you to consider if you're preparing on a path to IPO.
Thank you. And I think that goes to why this is important to the venture community and venture investors in the first place, because there's no reason why they can't start now working with the companies that they operate with to make sure that they're setting them up for success. I have a couple of other questions. Jake, about third party assurance, that does seem to be an area that is growing, but is quite costly and still nascent. Is the hope that if the SEC is going to require third-party assurance in the future, that environment or those sorts of companies will grow those practices so they're more accessible? Do you think? You don't have
Yeah,
to.
absolutely. So this is certainly one of the places where I think practical concerns about costs and burdens associated with the rule are valid, and it's something the SEC considered strongly. And so they modified their assurance provisions as well. The way that this works in practice is there's two levels of assurance. One is limited and one is reasonable. So limited assurance is the less burdensome of the two. It involves less work on the auditor's part, and it results in a statement in the negative. Like we did not, come across any information that led us to believe there was a misstatement in what the company said here. Reasonable assurance is the higher of the two levels. And that is the assurance level associated with the financial statement audit, for instance. And so it involves a lot more sort of evidence gathering and document review by the auditors, and it results in an affirmative statement that we have, reviewed this and we agree with it. So limited assurance begins very far in the future for any reporting company. I'm going to use large accelerated filers as an example. They're the largest category of issuer. So the first disclosures that a company would make in that category would be in their 2026 10K based on fiscal year 2025 data. Those are more of the narrative disclosures and the financial statement stuff, not the emissions. The emissions would be in your 2027 10K based on 2026 data. The limited assurance, so the less stringent of the two levels, would be based on fiscal year 2029. So you have 3 years from when you begin reporting emissions to when you have to obtain limited assurance. You have 7 years from when you start reporting your emissions to obtain reasonable assurance. So I would say this is actually an element of the rule that got a lot of attention and criticism from more progressive circles and the environmental groups who are suing because it is so permissive. I think we deal with a lot of companies at Ceres who are already voluntarily obtaining at least limited assurance on their emissions data. So the SEC, I would say, took a very lenient view of this. And as I mentioned, smaller reporting companies and emerging growth companies, and that second category, EGCs, if you're considering IPOing, as long as you're under, I think, $1.2 billion in revenue and you're in your first 5 years of being public, you're an EGC, an emerging growth company, and they don't have to report emissions at all, let alone get assurance. So that shouldn't really be a factor for most newly public companies. But the SEC also recognizes they're not going to require the sort of the big four accounting firms doing the assurance work. They're also going to permit smaller sort of greenhouse gas emissions focused service providers to give that third party verification, provided that they meet certain independent standards that are consistent with other SEC obligations. So we expect a lot of service providers to pop up. Certainly, we hear from a lot of larger companies that the big four accounting firms are giving them a ton of inbound interest in providing this assurance. It's certainly more costly for smaller companies who don't attract that sort of inbound interest, but we think that the landscape of assurance providers is going to evolve by 2030 or whenever it is that these are actually required in SEC filings in a manner that makes this less costly.
Thank you. That's really interesting and goes a lot to what we see in the Project Frame community about sort of goal setting versus what's actually required and being ahead of the curve. We'll talk about this a bit later, but competitive advantage is something that's very important to investors and ventures alike. In the interest of time, we are going to move forward. I hope you will stay with us and hopefully we'll have some more time for questions towards the end, but I would like people to give you a little virtual round of applause. Thank you so much. That was fascinating. And I think I will have to go back and rewatch the recording to make sure that I fully understand. Thank you so much, Jake.
Thank you.
All right, next I'm going to welcome Jenny Zhang, who's going to walk us through a prime case study. Welcome, Jenny.
Thanks, Carrie. Well, hi, everybody, and welcome. And very excited to be here today. My name is Jenny. I'm the Impact Manager at Prime Coalition, and I'm very excited to talk through with you today a case study of how Prime Coalition applies the Project Frame's guidance on pre-investment impact assessment methodology in our own impact due diligence and investment. And just a really quick reminder before I start, this is a case study and not providing any financial or investment advice here. So the plan for today is to first tell you a little bit more about Prime Coalition, and we'll dive into the case study where I'll walk through how the different aspects of the methodology, from constructing the unit impact to integrating volumes, all fit together, and finally arriving at our estimation of GHG potential impact. Many of you might already be familiar with Prime, but for those of you who are not, Prime Coalition is a nonprofit organization on a mission to unlock catalytic capital and change the future of climate change. We envision a world in which humanity thrives without the threat of climate change. And we strive for this vision through two strategies. The first strategy is influencing capital, and that is the Project Frame and Crane tool that we all know and love. The second strategy we have is where I'll talk more about today, is our steering capital strategy, where we partner with investment teams and launch catalytic funds to target areas where there is both an unmet capital gap and a significant impact potential to address climate change. So right now, Prime have two catalytic investment fund interventions. The first is in venture capital, and that's in partnership with our lovely colleagues at Azola Ventures, bidding off of Prime's decade of experience in climate ventures from first syndicated investments and then Prime Impact Fund. And the second area that we just launched, which we're very excited about, is in first of a kind climate project finance, and that is with our Trellis Climate investment team. As a catalytic investor, we at Prime and our investment partners were very unapologetically impact first. So this means that we do not require market rate returns, and we really view impact as our North Star in all our decision making. We have 3 investment underwriting criteria for our catalytic funds. It's impact potential, which I'll talk more about today on the GHG impact assessment part. additionality and bridge to somewhere. And one thing to note here is that our additionality and bridge to somewhere assessments are really focused on the company, whereas our impact potential assessments, as you'll hear later, is focused on the solution. All right, so without further ado, let's dive into this case study. So today we are looking in at a solution that is a proprietary modular carbon capture device that can retrofit into commercial HVAC system. And this device can both scrub the CO2 and other air pollutants that come through the ventilation air and recirculate this clean air back into the building. So we see two ways that this solution can deliver impact, or what we call here impact pathways. The first one is direct air capture of CO2. And the second one is because this device enables a closed loop recirculation of air, it reduces the energy consumption need for HVAC systems to continuously cool or heat air from the outside to the desired temperature. For each of these impact pathways, we think about the relevant effects, either positive or negative, as you see here on the slide, and I'll talk more about each of these effects later. So to give you a sneak peek at how the story ends, our assessment on this solution shows that the solution passes Prime's impact potential threshold of at least 0.5 gigaton of CO2 equivalent cumulatively reduced or removed by 2050. All right, so now let's dive into unit impact and see how we scoped the calculations here. First, we wanted to think about what is the unit of analysis here for us, both for the solution, or what Prime calls the impact scenario, and for the status quo, or the baseline scenario, or counterfactual. So here, the unit for the solution is this carbon capture and air purifying device that's retrofitted into existing HVAC systems. Whereas in the status quo, or in the baseline, it's just a good old conventional HVAC system without this novel device. We then think about what are the positive effects that this solution can have? What are the ways this solution can reduce emissions compared to the status quo? And we see two avenues here, or two effects. The first is removing carbon directly from the air. We know from the company that a single unit of this device can absorb 15 metric tons of CO2 per year. The second effect here is reduced energy usage for HVAC systems because of the ability to recirculate air and the reduced need to do continuous heating and cooling and getting new air from the outside. Integration of this device can reduce the energy consumption of existing HVAC systems by 25 to 50%. In addition to the positive effects, we also want to think about the negative effects. So thinking about where the solution can increase emissions compared to the status quo. And there's also two areas we see. The first is on electricity usage. So operating this device takes electricity, and we know that each unit of operation consumes 1,500 kilowatt hours per year. And the second way where emissions could increase is from material transport. So after integration of this device, there will be additional transport needs to transport input and waste materials, both to and from the building site. And our assumption here is that each unit will require the transport of 40 metric tons of materials over a distance of 250 miles. After we build this mental model of the positive and negative effects associated with this solution, we also want to take a pause to make sure we document the key assumptions and parameters in our assessment. And this step is really important because we're dealing with really early stage technologies that inherently have a lot of uncertainty. And we really want to make sure that we're being honest and transparent about our assumption that we're putting into these assessments. And the parameters will show up in a way that you can see later. They're going to feature into our scenario analysis, which we at Prime use as one tool to present a more robust analysis on these technologies and solutions with higher uncertainty. So in the case here, we have three key assumptions. The first one is there's no incumbent. So we're assuming that this device or solution is purely additive to existing HVAC systems, and it's not replacing any existing components of the system. Our second assumption here is around energy use. So we assume that the energy use of commercial HVAC systems remain constant over time. And this assumption is important because, as you can recall, one of the emissions reduction effects is a % reduction of energy use for the system. And our last assumption here is the energy source for the HVAC systems, where we assume 30% of the energy will be produced by natural gas and the remaining 70% by electricity. And we also assume this ratio stays constant over time. On the parameter side, the two parameters we vary for our scenarios are first, efficiency improvement that's enabled by this device. So this is the reduced energy use for the HVAC system. And the second one, the parameter we vary is the emissions intensity of the electricity. Here we use grid electricity, drawing on IEA projections and scenarios in our impact modeling. All right, so now it's time to put it all together. As a reminder, we have two pathways here. First, a direct air carbon capture, and the second is improved HVAC efficiency or reduced energy use. And for each of these pathways, we've combined the positive and negative effect to arrive at this net unit impact. And now that we've had the unit impact, now it's time to integrate volumes into this calculation. The project frame guideline has some really great information on market sizing considerations. So at Prime, we often start with thinking about the total addressable market and then adding additional layers of bounds to narrow the scope down to the serviceable obtainable market, which is what we're really after in this assessment. So in this specific example, the total addressable market we see is global commercial floor areas, which we assume to be 2 times of the current US commercial floor areas. And this is assumed to remain constant through time. And we know that this technology is not well suited to operate in all sorts of climates and temperatures. So we made an additional assumption to bound this TAM to SAM by assuming that 70% of the global commercial floor areas is located in spaces or locations that's suitable for the deployment of this technology. So we started with the TAM, total commercial floor areas in the world, narrowed it down to SAM, which is the commercial floor areas in climate suitable locations. And the final step is to further narrow it down to SOM or serviceable obtainable market by incorporating this adoption S-curve. There's a very complex math equation behind the S-curve that I won't bore you with today, but wanted to highlight the 4 key input into that equation here, which is number 1, the deployment year. So this is the year that this technology will first deploy in the market, which in this case, we assumed it to be 2025. The maximum market capture potential. So, at fully deployed scale, what % of this serviceable addressable market can be captured by this technology, which here we assume to be 100%. The inflection point, this is the time it takes for the S-curve to hit that pivot where it really steepens up, and it's 15 years in this assumption. And the penetration steepness here we assume to be 0.5. And the final step, assumptions and calculation we make here is to bridge this market sizing, which is at the level of commercial floor areas, to our deployment unit, which is device. So we assume that each device can service 20,000 square feet of commercial floor area. And now it's time to bring it all together, the unit impact and the volume, to arrive at the GHG potential impact in the end. This graph here shows you our modeling result. On the left-hand side chart, you can see the 3 scenarios we modeled, and this shows the annual GHG impact potential. On the right-hand side, it's the cumulative GHG impact potential. And as you can see on the curves on the right-hand side here, all 3 scenario clears Prime's threshold of 500 million metric tons or 0.5 gigaton of CO2 equivalent reduced or removed cumulatively by 2050. So that is it. That is an example of how Prime applied the frame methodology in our assessment. Happy to answer any questions you might have.
Thank you so much, Jenny. That was really fascinating. We do have a couple of questions in the Q&A, but to kick us off, you didn't really touch on this, but I know it's really relevant to our group. Prime considers additionality a little bit differently than a lot of others. And I know it's vitally important in order to even consider doing an impact assessment and deploying capital. Can you speak a little bit about Prime's approach to additionality and where it fits in this process and how this process is gating to deploying capital?
Yeah, great question, Carrie. So as I've explained, at Prime, we have three underwriting criteria: impact potential, additionality, and bridge to somewhere. So in this sense, additionality, it's one of the three prongs that we look at, and it's one of the gating criteria for investment. And additionality is used in many different ways in the impact world, but the way we use it at Prime is we really want the concept of additionality to capture where there is a gap in the market that charitable capital can fill. So the way we phrase this additionality question is the but for question. What climate impact could not be enabled, accelerated, or deepened but for the participation of a investor with charitable purpose like Prime? And so there's a whole separate work stream of assessing additionality aside from the GHG impact potential that I've just presented. And that involves taking a lot of information from investors, understanding the circumstances of the round, and also Prime staff making the final evaluation. And this assessment is gated by our mission alignment committee, who review our assessment. And if Prime staff decides that this investment opportunity does not meet our additionality threshold, then this investment will not be able to proceed. I hope that answers the question.
Yes, thank you very much.
Hi, Jenny.
Good to see
Yeah,
you.
my question is, I'm curious for the S-curve that you model. Do you use that pre-investment in some way or post-investment, or how do you use that S-curve that you model?
Great question. So it is a part of our pre-investment methodology or modeling. So that S-curve, as you can see in the way we scope market, that S-curve is what we multiply by the serviceable addressable market size to get to the serviceable obtainable market size, which is that volume piece in the equation before we get to the GHG impact. Does that answer your questions?
Yeah, thanks.
Similar to that, you showed 3 different scenarios. Why are there 3 different scenarios? Could you go into that a little bit?
Yeah. So as I was mentioning, with these early stage technologies, there's a lot of inherent uncertainty and there's a lot of unknown, frankly, about the world going forward. So we wanted to try to address some of this uncertainty by using scenario analysis as a tool. So what scenario analysis allows us to do is to think about what is a low impact scenario, which is think about almost a negative view on the future. That could be in the sense of electricity grid does not decarbonize as fast as we want it to be. That could be this technology is not as efficient as we want it to be, or other assumptions there. And then the high impact scenario allow us to think about what if all the stars aligned and we got green electricity, we have a really efficient solution and everything worked out well. What could be that high end of impact potential? And the medium scenario is in the middle of what's a medium projection of the future. So having these 3 scenarios allow us to not be married to just one assumption in a sector where there's inherently a lot of uncertainty and there could be very large bound of this uncertainty, and allow us to see this picture of what will be the lowest impact, what will be the highest impact, and what do we think are plausible to happen. So that's why we use the 3 scenarios. And the way we use them at Prime is that the analysts construct scenarios as to be plausible scenarios. So none of these scenarios is pie in the sky or implausible. We think these are all plausible futures. And as long as one of these scenarios crosses our impact threshold, we think this solution has enough impact potential to move forward.
Whereas if it was only one scenario that it seemed to have high impact, maybe it wouldn't warrant the investment in Prime's case.
I think we need at least one scenario to cross. So if it's just one scenario to cross and it's a plausible scenario, we would still think it warrants investment. Partly because Prime's catalytic nature is we want to be able to take high risks that other investors might not be able to take, and we want to dream big and support solutions with potential high impact.
Great, thank you. Lots of questions in the chat, so I don't think we're going to be able to get to all of them. One that sort of I think is similar is when you're considering all the different effects for consideration, like what is an example of like all the different effects that you consider? This person said, for example, with a battery manufacturer, would you look at the amount of critical minerals used, and how do you create different benchmarks? I think you talked about benchmarks a bit, but if you want to talk about the overall effects, what is the punch list for things that you look for?
Yeah, that's a really great question. And to be honest, we don't yet have a set list that we're comparing to. I know Project Frame, if I'm previewing a little bit, I know Project Frame's updated methodology guidance might include some list of factors that's more standardized for everyone to think about, which I'm very excited for that. But the approach we take at Prime is we try to think about the life cycle of the product and the solution, and to think about what are the most critical impact levers within that life cycle, and try to consider all the effects associated with that.
Thank you, and thank you for previewing a little bit of what's coming up next in Frame. Okay, so how did Prime consider the non-GHG social and environmental impacts of this climate solution?
Yeah, that's a really great question. So, while impact potential is one of 3 investment criteria for Prime, and the way we think about an impact potential is not just this GHG impact piece. We also really want to think about those non-climate, so other social or environmental co-benefits and risks that's associated with the solution. In this particular case, a co-benefit that we've identified is this device's ability to scrub pollutants out of air. As we know, indoor air pollution has really negative health implications for people. So we see that this device ability to scrub both CO2 and pollutants as a co-benefit for improving indoor air quality.
Great, thank you. There are more questions in the chat, Jenny, if you want to try to answer some of those directly or in the Q&A function. We are going to continue. Thank you again, virtual round of applause for Jenny. Really interesting. And just as a quick call out, if you are interested in doing a case study or an investor profile, please contact us at impact@primecoalition.org so we can discuss it with you. Several investors decide to go through the process for their own personal or internal review, and we do not necessarily need to share them publicly. So please keep that in mind if you're just interested in going through the process of an investor profile or a case study. Thank you.
Thanks, Carrie. Thanks, everyone.
Thank you, Jenny. All right, so now we are going to cover the 2024 annual survey results. For those of you who've been following us, this is the second time we did something like this. It helps us understand, for lack of a better word, the landscape of where people are in their forward-looking impact analysis journey. And we also talk about things like third-party verification and net zero alignment, just to see where those in our community fall as far as what are they able to do and what are they hoping to do in the future, so we can better align our programming to serve our community. I first wanted to go ahead and thank those who participated in the survey. This list is not comprehensive. It's only those who selected to be named. It's still a very niche area, climate VC investing, but we are really happy to see that so many investors are willing to take the time and fill out a survey when I know everyone receives lots of surveys every single year. So things that we saw this past year, our motivations for assessing impact basically stayed the same. Number 1 is concern for the climate or planet, followed by firm competitiveness, which was consistent with last year. Even though our community has grown by 130 individuals since we last assessed this in June of last year, we still are predominantly representing North America and Europe. It is a goal of project frames to try to include more investors in other markets outside of North America and Europe, which is why we did decide to start doing some translations and some targeted outreach to investor networks, particularly in Asia right now. So once again, a call for if you would like a translation, if you think that would help your network of investors, please let us know so we can find ways to better make our content accessible to you. Right. Next, it was exciting to see that out of the responses, while not so surprising, investors are actually using the methodology for their forward-looking impact assessments. We're really excited to make some modifications that we will share with you a little bit later this year. It is also interesting that how many respondents are working on a path to net zero. So as our community has grown, the percentage, I believe, has decreased slightly. So I think that is something that we'll continue to monitor. The principles, of course, have a lot of alignment. If you're interested in learning more about those, they're on our website. But what is really interesting to us is that 91% of the investors that are responding to this are still looking for above market rate returns. I think Prime, who we represent, is that we are impact first, led by our investments, and that the majority of the respondents are led still first by financial incentives, but are hoping to have impact. So we're trying to find more ways to raise the bar for what forward-looking impact assessment looks like for our investors that are still seeking those above market rate returns. And we have the industries represented here as well. Right. Investment fund types, still majority venture capital. Private equity and growth equity is starting to increase. So we are thinking about how we can transition our guidance from purely VC to other types of investors. That is something that is not concrete yet, but is in the works, and we hope to discuss more. If you're interested, either as a growth equity fund or private equity fund, in talking about how we can better communicate our content for your needs, please reach out. It's something that we're really hoping to grapple with in our next content working group. And this sort of goes a little bit to Jake's presentation, but we also monitor those who are using third-party verification and whether or not impact assessment is happening in-house or with outside contractors. The fact that the in-house is so robust is actually, to me at least, very encouraging. Whereas the sense was last year that there wasn't as much in-house capacity to do this work. So we're excited to see that more feel like that they can do this work well within the own bounds of their organization. I welcome you to raise your hand if you have additional questions about the annual survey or frame content and programming, or any questions for Jake or Jenny. I see something in the chat about post-investment work. Right now, a great place to get information on how to manage impact post-investment is through our investor profiles. So whether you watch the recordings from previous investor profiles that were presented during our community meetings, or just going through the investor profiles themselves, we talk about the life cycle leading up to investment, but also there's a little bit of post-investment management. We haven't provided guidance directly as the Frame community on what post-investment management looks like, but that is also something that we're considering for the future. All right, I just want to thank everyone once again for your commitment to investing for our planet. Many thanks to our speakers, Jenny and Jake. It was very interesting. I personally learned a lot. And a huge thank you to those who are working behind the scenes on the Prime team for making sure that this is run flawlessly. I look forward to seeing everyone else at our next community meeting, which we will be hosting in June. Thank you and enjoy the rest of your day.